Nerd Stock Talk, episode 9. We have with us a special guest tonight. So people who are local to, where JP and I have live and work and also went to school, we have with us one of our he's eating a crayon right now. Richards. He is a retired teacher. He was our teacher for many years. Not so long ago because we're all very young still. And this is episode 9. You can check us out if you watch us live, 8 p.m. Eastern Standard Time every Saturday night. And if you're catching this as a recording, thank you. Make sure you hit the button to like and subscribe and comment and all that other kind of fun stuff. But here we got JP and Bruce. Thank you for joining us tonight. This is going to be a fun half hour.
Thanks for having me.
You're welcome.
Bruce, what flavor crayon are you eating?
Well, I'm going for the orange. As an older man ape, I just find that the orange is a little more satisfying.
No, I agree. Sometimes I might spring for the yellow, the lemon, but the orange is delicious too.
Lemon curd, very fruit.
Here we go. All right, we're going to just jump right into our first ping, our last week's pick. All right, so JP, what we always like to do is and Bruce is an avid viewer of the show, so he knows the routine. So we like to look at who did the worst from the week before, and then we did who did the best. So JP, talk about your stats, your long pick.
So I did the worst, huh? Is that what you're trying to say?
Well, yeah, compared to yeah.
Oh, okay, yeah. It's been a rough few weeks in the stock market, at least in the tech sector where all of my eggs live. So that's what's going on. It's definitely coming up on my charts. It's green. So I don't care what your little chart says. It's coming back.
But Canoo has, this is the, because we always look at that as your long pick. That's one of your, and then once we start getting 3 months in the show, we're going to look at 3 months. But it has, the deficit has starting creeping up because last week it was around minus 15. So it's at 7.5. So, and this is still your long pick then?
This is still my long pick. This is a new company. They just went public in December. And they aren't scheduled to actually start making any money until 2023. So I really think that this has got the potential to at least go to $100 a share.
Okay, and it's at $15 a share right now. Yeah, and talk to us about Northern Dynasty Minerals. How did that was the one you're just looking at this past week?
Yeah, they're working on a huge tract lithium mine in Utah, I believe. Maybe it's Nevada.
Right.
It is up for approval right now. It would be the largest in the United States if it gets approved. This is definitely a penny stock. NAC has been as high as $15 in the past, but they sort of exhausted some of their mining resources and are looking for new plots to mine.
Okay. All right, good. And I'll just show you what I went at. And with Tencent, as I say, that's still my long pick. It's gone up and down. There's been a lot of trade and there's been a lot of issues happening in China with some regulatory stuff. Hit hard with a lot of those big tech stock that's happening. But I'm still holding on to it. It was going down a lot, so I sold my shares. But then as it was starting to creep back up, it kind of dipped. So I bought it back in, so I didn't lose anything on that. And I was wrong. A little mea culpa for our audience out there. Scholastic has been struggling over the last. They've hit their mark basically over the last couple of quarters, but it's because there's no school book fairs. There's no school book fairs, but people are still reading books. So before its quarterly earnings call that it had on Thursday, the stock was going up because investors were predicting a good quarterly earnings stock, but it turned out that it didn't do too well. So then it started to go back down to where it was at the beginning of the week. So so Scholastic it's still hanging in there, but it's It's gone up a little bit, but it hasn't gone up as much as it should have been. So yeah. So with that said,
Scholastic really tanked at the beginning of COVID, right?
it did.
There's still some significant upside to be had, I'm sure.
Right. Yeah, absolutely. So with that said, we're just going to jump right into our feature segment. So Bruce, we wanted to, and I remember years and years ago, you were talking about how you really got into doing investing, and like it's something that you've always and I remember you telling us, it's like you said it's not that hard. You just find, it's kind of like what JP and I have been saying since episode 1, is like, find the things you know about, learn about it, and then just kind of start from there. And we wanted to pull you in and just, and give you this platform to kind of expand out your audience a bit, instead of just JP and I and some of your other old past students who may or may not have listened to some of this advice that you've had, but
probably not.
Probably not. So with that said, what would be some advice, like with 3 things? What are 3 things that you wished you knew at 30 that you know now?
All right. 3 things.
3 things.
When I'm 30.
Yeah.
Okay. The first thing would be abandon the sexual revolution before the reign of terror sets in.
No. With investing.
Investing.
Just investing.
Oh.
Just investing. Yeah.
Okay.
We'll try to keep it focused.
Focused on that. Okay.
Yeah.
Well, then it would be start investing. And I didn't start when I was 30. In fact, as you noticed earlier, I can't do anything without Leslie and even get on to this format. So once I found Leslie in the 80s, her dad told me, don't you have an IRA? I said, IRA what? Beer money, but no, you got to start investing. So the first thing would be to start early.
Yeah.
Time is on my side. Yes, it is. Well, it is. And and I would start with first fund your IRA. Okay. Now, the mistake I made is I didn't put enough in a Roth IRA once they became available. So I have a lot of money in regular IRAs. The premise being that when you retire, you'll be in a lower tax bracket than you were while you were working. So don't pay, put it in a regular IRA, pay the taxes when you take it out later. But I find them in a pretty much similar tax bracket. So that didn't work out as much. And I wish I had more in the Roth, because then you take out a big chunk of money in the Roth, pay no taxes on it. Pretty sweet. Either way, it's growing in these IRAs, without any penalties, without any taxes. Okay. So now what do you put in there? Well, asset allocation is the key ingredient to investing. I was reading today, 88% of investment returns have to do with just asset allocation, like 75% stock, 20% bond, 5% cash. If you put it in that and in almost anything and left it there for 40 years, 88% are about the same. So it's the asset allocation. When you're younger, you want mostly stock, and that's what I did. I started out with Magellan. Leslie's dad said best mutual fund is Magellan, which is Peter Lynch. You may remember he was famous, and from 1977 to 1990, he had Magellan Fund, which had an average 29% per year during that time. So that was a really good place to stash an IRA. It faded, as even Peter Lynch, which is a good lesson here. No one beats the market. No one beats the market. So people beat the market for a while, just like gamblers beat the house for a while. Nobody beats it all the time. So So I established asset allocation, trying to get the whole market, and having very low fees. I made the mistake early on of having a friend of mine as a financial advisor, and he wasn't doing very well. And when I parted with him, and I just started to go to I went to three different. I went to Fidelity, T. Rowe Price, and Vanguard, which you don't need to do, but I like to fool around with them a little bit and really diversify. So I would choose, very, very low fees. I mean, now I have a lot of stuff in index funds, ETF index funds at 0.04%. It's almost nothing. So I'm not paying anybody to fool with my money. I was paying places to keep it safe and invest it according to a plan. Basically, I was shooting for 8%. I thought you could get 8% return. That's kind of what the market has been able to do over the decades. And I've done a little bit better than that. I'm pushing closer to 10% over all that time. Again, I have way more than a person needs, but I also like to have fun with it, because my fun is not like you guys. You guys are really playing a game, but I like to rebalance. Okay, so I look at it a lot, and this stock fund is down 200, and my international bond fund is up a couple hundred. All right, switch them. And then when the opposite happens, switch them back. So I'm doing a little bit better than just having left it there. Not a whole lot, but the rebalancing has caused me to do a little bit better than I might otherwise have. So now I've got 53% of my portfolio in stock funds and 43 in bond funds, and the rest in cash, which Vanguard tells me that at my age, 73 and a half, is a little bit too much stock. That's a little risky, actually, the 53%. So I'm pushing it a little bit. I'm probably going to gradually come down to 50% stock, 50% bond and cash, 45% bond, 5% cash. So this mix, having there somewhere, has been traditionally since 1926. My allocation has yielded 8.4%, which is pretty cool, because remember what happened? Well, it happened many times, but it happened big time after 1926. I'm not that old. 1926. You had the crash of 29,
right?
And yet, all through the time, this mix just left. This mix has made 8.4%. Now, guess which was the worst year in all those decades?
2008.
No, way back.
Way back.
Yeah, remember, this starts in 26.
Okay.
Is it
69?
29 seems like it would be too obvious.
29 is too obvious, but you're real warm with that. It was 31.
31.
31. This allocation went down 24%.
Why?
It's not the end of the world. I mean, if you put all your money in there and just left it, you lost 24%. So you still had 66%. If you just needed to leave it, okay, and it would come back up. And then the best year, this is what surprises me, the best year in all that time happened in 1933. The stock market went up enough, because it was down so far, that it went up 34% in 1933 for this asset allocation.
That's similar to this last year, isn't it? There was rather profound, and so was the growth following it.
So so like you said, your first piece of advice is start your retirement funds now.
Yeah.
Like, and the second one, as you said, that I thought that was pretty good, is that it's, you have to, work with, you have to make sure that it matches your, what do you say, like your expectations of growth, like switching it from bonds to stocks, depending on
Rebalancing according to your age.
Mhm.
And they think that I'm too old to have that much stock now. So, but basically, yes. So I went from 100% stock mutual funds, and now I'm at 53%.
Was there any, when you were younger, did you have always done funds, or have you ever done individual stocks?
Never did individual stocks, only funds.
Okay.
And say a whole variety of types of funds. Again, because it is fun for me to do so. I have real estate, and I had a little piece of lots of stuff, but except gold. I never believed in gold. I had friends who were cashing out and buying gold all the time, and that wasn't panning out. Haha, pan for gold. It wasn't working for them. So I never went there, but yeah, a whole variety of things. And my most gambling quote, I don't know, dangerous. I can't fetch the correct word here. Mutual fund is Vanguard Information Technology ETF, and that most risky. And then I have funds in like ultra short-term treasury bonds, which are really safe. So I got the whole gambit of the. Most investors don't want to play with so many, or with Fidelity, T. Rowe, and Vanguard, but it's just kind of for amusement, I like to. And but this information technology, and I heard one of you guys making like 50. One of you say you cleared 54% this year with your investing. I thought I heard one of you mention that.
Yeah,
JP. And so I just had to check this out. And well, this one, my most risky, made 53% last year. So it's only like 2% of my whole portfolio. So, so it's not, if it tanked, it wouldn't be the end of the world.
How is your Bitcoin investment doing, Bruce?
The Bitcoin, you told me, you made me buy Bitcoin.
When was that? That was back in a long time ago. Yeah.
I bought $100 of Bitcoin and $50 of two others whose names escape me. I have it on a piece of paper somewhere, and can access it now.
Oh, good.
I lost that. I thought I lost the piece of paper. I don't know. Oh, I don't think it's worth a ton. I think it's worth more than what I paid for it.
It's got to be up over 100% by now.
It could be. It could be $200 worth. That was my guess. So that's good. So again, my tendency is to just sit on things like that and see what happens.
So that's always been that's always been a specific strategy of yours, not to do individual stocks, but always stick to funds then?
Yes. Yeah, because again, broad diversification is one of the premises I follow. Low fee, asset allocation, broadly diversified. So I have international stocks, international bonds, cover the gambit.
Right.
But like the index funds, which now again I'm moving into ETFs because they're slightly lower fees.
Right.
And they're fun because you can trade those during the day and don't have to wait to see the end of the day. But the S&P 500 index, total stock market index, these things they cost almost nothing.
Right.
And they've been doing fine. And again, never buy when it's down. I mean, never buy when it's down.
So buy high, sell low, right? That's what we've been doing.
Yeah.
I got this.
Yeah, that's the adage. Yes, but so yeah, I think this is not rocket science, and it's the conservative way, and again, it's now you guys are more like gamblers, and you're both really two of the smartest students I ever had, although you didn't perform that well. And you know about things, and if you know more than others, and the gambler there are some gamblers that
you can make a living at gambling. I don't know why that's.
Well, what is it? Well-read gamblers. Is that what you called it, JP? Is that?
Yes.
Yeah.
And, I mean, don't make me sing the Kenny Rogers song. I will. I'll sing that song.
But when you mentioned earlier, Bruce, where you said that it was
Kenny Rogers passed this year.
Yeah.
For that, and you may know that I used to be mistaken for him back in the day. Yeah. There's a woman who's telling her, you're nervous, but who's telling her friends when he died this year, I spent a night on a New Jersey beach with Kenny Rogers back in the 70s. Don't tell her.
And so, what over the years? What was your best return? 54%, the best.
That's pretty good for 1 year. Let me just see.
.com bubble. Did you get any tendies out of that? Or were you on board for the oil boom or the railroads? Did you get any of that?
Well, I mean, the mutual funds had these things all in them. Sure. Yeah. They had them all in them.
So you really rode the rise of the railroads and.
I did. That Continental Railroad was very good to me. Very good to me. And that was, yeah. But like, for instance, just so my Vanguard, 1 year for Vanguard, 14.6%. 1 year and that's with 47% stock. Fidelity, 53% stock, 1 year, 22%. So quite a bit better because there's more stock in this past year. And in T. Rowe Price, that had 58% stock, that made 48%. All my I have about a dozen different mutual funds in there. That made 48% T. Rowe Price.
So Bruce, we had
longer. Just and I know this is kind of hard to follow these numbers, but the Vanguard in 5 years has made 10%. The Fidelity with the 53% stock has made 5 years 12%, and the T. Rowe Price that did 48% this past year was 9% over 5 years.
So one of your other previous students just complimented, saying that you're one of the OG standard oil stock buyers. So
oil stock,
yeah.
That's
my other brother Adam. He's saying that you were one of the first people to buy stock in oil. So
now, was JP Morgan a nice guy?
He's a nice young guy. Yes, my other JP friend.
God, do JPs. All right, so we're wrapping up the episode. So this has been great, Bruce. I think this has been some, and I think what I'd like to do is try to start a semi, having you come on, on a semi-regular basis with some tips for to get ready for retirement. So
you can be like that Rupert guy on the Letterman show.
All right. So before we end the episode, Bruce, if you have anything, we're just going to talk about what we're watching for next week. Is there anything that you're watching this next week coming up at all? Anything specific you're not necessarily investing, but anything you're interested in, you're watching this upcoming week?
I'll be watching my twin grandsons. They're 2 years old, and they're identical.
That's true. Yeah. Can you tell them apart?
I'll be watching for differences.
Yeah.
And
Do you have to label them? Is it the point where you have to label them? Like you have to know which one is which?
yeah, there's usually a scratch on one that I can identify every day, and that'll be the. I don't put the scratch on.
They're 2 years old, so they're probably used to Grandpa calling them by the wrong names.
But they're
Yeah.
yeah. But it's been a metaphysical awakening for me because they are very different.
Oh yeah.
So I think one soul per customer.
Right. See, there you go.
I'll leave you with that.
There you go. So real quick. So I just want to let you guys. I'm watching Lowe's this next week. It's been going up. There's been a lot of that. There's housing bubbles, home improvement bubbles. This is a time to. I've seen a steady increase in Home Depot and Lowe's. I just prefer Lowe's, so that's why I'm watching it. And JP, do you want to talk to us about? You still have Northern Dynasty minerals on there.
We still have Northern Dynasty minerals. It's not GameStop. It's Ferroglobe is GSM. It's
okay. I got to change that. Okay.
Another mining outfit that mines silicon and a bunch of materials for making solar panels.
Right. Okay.
And then Sundial is a cannabis stock that is suddenly paid off all its debt, sitting on a pile of cash and looking towards American markets. It's a Canadian company.
Okay.
It's probably undervalued. I don't know. It's a complete gambling play, but yeah. I'm kind of going into bear market mode. Bond yields are kind of scaring me a little bit. And I think we're definitely due for a drop. So I've actually started just hoarding shares of those companies, mostly because they're rather high volume right now. Right. And I'm selling calls.
Yeah.
Calls. I've actually done quite well. I've brought my cost per share on Northern Dynasty. I bought in at about 82 cents, and I've brought my average cost per share down to about 27 cents right now.
Wow.
But at the end of next week, I'll own those shares for free. Just selling calls on them.
Just selling calls on them. Cool. All right. Well, thank you very much, everybody. And Bruce, thank you very much for joining us. We certainly appreciate it.
Thanks for putting up with me.